Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with a very special guest, Lior Gantz, one of the smartest people I know, actually. He's an entrepreneur and a guy who follows the economy very closely. And more importantly, he's in front of the trends. And he's someone who strikes while the iron is hot. He's the founder of Wealth Research Group, and I highly recommend you go and follow his work and check him out and get to know him. Lior, thanks for coming on Crush the Street with me today.
Thanks for having me, Kenny.
Lior, you're someone who knows how to be in front of the trends, and by doing this, you make people money in the process. And the Fed seems to be unsure about how to proceed forward this year. The trend, I suppose, is that they'll raise interest rates in the face of a volatile economy. But I'd love to get your thoughts on this. And, what is your mindset going forward here in 2018?
I think with regards to how the Fed manages their balance sheets and how they manage the Fed funds rate, I think these are very difficult times for them, because the economy is doing very well, and what they did in the time that it was doing poorly was create too much liquidity or access liquidity. In 2008, in my opinion, they created liquidity for many institutions that were needing to cash up and to normalize their balance sheet. So that credit got absorbed real easy, and it didn't create inflation like many people thought, because the economy, the general economy, global economy, needed to be cashed up. And in our system, unfortunately, cashing up means getting into debt, and that's what happened. The Fed had to accommodate, buy bonds on its own, and make sure that the bonds market stays afloat, and it needed to bail out institutions, which means basically getting taxpayers in debt. But the alternative to that, in their minds, was a complete reset. And obviously, if you are in control of the system, you don't want to relinquish control. So if the people in the US don't rise up and actually march on Washington, I don't think that they will change their strategy. They will only try to make sure that the people are at ease with what they're doing, but they will never say, hey, you know what, we're wrong, our system is bad, let's try something else, or something like that. So the power to issue currency is so intoxicating and so important to them that they'll never relinquish it unless it's on the brink of a real revolution in the United States. Unfortunately, 2008, it gave this window to the citizens of the United States to say, hey, no more. This has just gone far enough. Our national debt is too high, etc. We want to do something about this. But they were convinced and duped into, overall duped into accepting that, hey, this is the best that we can do. TARP money, bailouts, etc. And obviously they got very mad at Wall Street bonuses, etc. But in terms of the economy, it absorbed all this credit. But then what the Fed wanted to do is show, hey, we not only save these institutions, but here, look at the stock market and look at the real estate market. They're doing very well. So they needed to create extra liquidity. They needed to actually buy assets. The Fed now is 40% of the GDP. That's insane, right? 4 out of every $10 is made up funny money. It's just, it's not even the real economy. But it jolted the stock market, it jolted the real estate market, and now they're at a point where, hey, demographically, the U.S. is an aging economy. There's 51 million retirees right now, but it's going to grow by 60%. And that's huge. There's no other country in the world except for Italy and Spain that are facing the amount of new retirees that will happen in the next decade. So from 51 million people, it's going to be 80 million people that are what we call the dependents, right? They're going to be on Social Security, they're going to be on Medicare and Medicaid. They're going to need other forms of subsidies as well. And that is horrible in terms of the balance sheets of the United States, because Social Security and Medicare are combined already $2 trillion. So that is, on one side, that's horrible for the federal government. For the workplace, for the workforce, Kenny, that's positive. You see all these people leaving the workforce, which creates job opportunities for millennials. And so there's about 5.6 million openings right now. You can expect that to be about 8 million people in a few short years. And you can't replace a 60-year-old worker with a 25-year-old worker that easily. They're not the same skill level. So wages need to rise, and they are rising for the first time since the 90s, and meaningfully since the post-war era, where people, employers need to make sure that, hey, I want the best labor, and I only can compete with these people, so I need to raise wages. When wages rise in an economy where the savings rate is about 2 to 3%, you're at a risk. You're running a risk that people will spend all of this disposable income into the economy, and coupled with the tax cuts and coupled with the proposed infrastructure plan, that's a lot of jobs and a lot of people making extra money. And if that extra money is not invested correctly, and rather it's spent, which most likely will happen in an economy where 72% of the consumer spending is service, then you run the risk of inflation. Now, the US doesn't need to go on 10% inflation in order for the stock market to tank and in order for the economy to hit a recession. It can be 4 to 5%. It's that big that and that efficient that if corporations and if CEOs cannot plan into the future because their costs are going to go up by 5%. So, hey, what am I going to do next year? Am I going to pass? Am I going to move my cost into the consumer or not? If I move that cost into the consumer, will he go to other businesses? All these questions come up when you have inflation, and that is not good for investors because they can't figure out the intrinsic value of companies that they are valuing. So inflation is a real bitch to the stock market, to the real estate market, to employers, to small businesses, to everyone. And so, yeah, it's great that you have rising wages, but it's not good if those wages are spent into the economy and just create inflation. And I'll give you the best example of this. If you take a loaf of bread priced like $1.60, in that loaf, there's only like 8 or 9 cents worth of wheat. So if wheat price doubles, what happens to the loaf of bread? Nothing too crazy. But if all the supply chain, from the farmer to the guy who sells equipment, to the guy who packages the loaf, the wheat, and to the guy who manufactures or bakes the good, and to the people that come to the store and are the salespeople, if all of them are seeing rising wages, that goes to the bottom line. And you're going to see general inflation, not just inflation in tuition or entertainment or healthcare, general inflation across the board. And the Fed is trying to avoid that as much as possible. So they need to raise interest rates just as little as possible so they tame inflation, but not too much so that they slow down the economy, where borrowing costs are already close to 700, 800 billion a year for the federal government. So if they raise it further, they're going to create a real bad situation. In fact, if you go to wealthresearchgroup.com/bonds, I highlight exactly how the bonds market, which is the largest equity market in the world and is the only one who is not imploded yet. So the stock market imploded in 2008, the real estate market imploded in 2008, the tech sector imploded in 2000. You had all these bubblish economies or bubblish sectors already implode. The bonds market hasn't imploded yet, so it's next. And I created a special report about why this will happen and what can you do to offset that. And I'll give you the full rundown on this. Because I know your audience is very sophisticated and I want to give you the full answer. The bonds market, just the treasuries is about $6.3 trillion in foreign entities that own U.S. treasuries. So $6.3 trillion is other nations that have loaned money to the federal government. Now, when you raise rates, when the yields rise on treasuries, let's say the 10% yield, and I just wrote about this in our newsletter, the 10-year treasury is 2.85 according to yesterday. That means if you buy a face value bond for $100,000, you get $2,850 worth of coupon payments a year, or interest payments a year. In 1 year from now, if the Fed continues on its trajectory of raising rates, let's say at 25 basis points every time, and they do 3 to 4 of them, you'll get to about 350 on the yield for the 10-year. So if I'm a new bondholder coming to the market, not bondholder A from a year ago that got paid 2.85, but bondholder B was now going to buy the same $100,000 worth of bonds and loan the government $100,000, and he'll get $3,500 for his bonds, right, in coupon payments. So you follow me?
Yes. And what it's leading me to is a lot of people have seen all of this as the everything bubble. And you've talked about some of the other bubbles that have already imploded, but many feel that we've reinflated these bubbles and we're at a new point here. And many people have looked to precious metals as a solution for this. And I know this is an area that you follow. And one of the things that you've looked into are strategies to make money in the mining sector. And if we could, let's switch gears here for a little bit and talk about this, like some of the best ways to make money in precious metals is the mining sector if you do it right.
Sure, and it goes back to this idea of accommodation, because as I said, many people in the hard assets sector expected that commodities and gold will flourish in an environment of zero interest rates and QE. But again, you didn't have excess dollars going to Main Street from 2008 until 2017. The Trump victory changed all this. So now the banks are willing to lend, and people are willing to spend. Small businesses are willing to hire, and the environment is changing to where if the Fed doesn't raise rates, then you'll see much higher inflation rates, and therefore they need to kind of hedge this. And so this is actually a great environment for the hard asset sector. Not yet, but in months from now, it will be great. What's missing right now, because the dollar is already in a bearish mode. It's already down 10 to 11% from its peak. It's essentially in a bear market. And so that's great. Gold and commodities need the dollar to be in a bear market to flourish. What's missing is that the stock market is still doing very well. And because of that, people are unwilling to move into precious metals or mining or hard assets and sell their tech stocks yet. So the next stage, or the final stage of this bull market, will be the stock market top, and then people will need to hedge, and they'll go into the most uncorrelated sectors for tech, and that sector happens to be a hard asset. So we're months away. But still, if you look at the last 8 years, gold is up, the miners are down, but there's one strategy that beats both of them. And it's the royalty model. So the royalty model in mining is so lucrative because it marries all the best in finance and avoids all the tough environment for the boom and bust mining sector. So mining companies, they have extreme overheads. They need to employ thousands and thousands of people in their mines. They need to constantly replace equipment. Their Caterpillar trucks are running on a massive amount of oil, and they need permits, and they need roads and bridges, and there's so much capital that is just absorbed in the mining sector. And the royalty model avoids all that. It circumnavigates all around that and just sticks with what works. And what works is the fact that commodities are always needed, right? So it goes back to, like you and I talked off the air, that we like to invest in pipeline companies in the oil sector and not companies that are exposed to the price of oil. We like to go where, hey, if oil is running through these pipelines because it needs to get to people who consume oil, these companies flourish, rain or shine, and we love to do that. We love the model where, hey, let's not go with the boom and bust economy. Let's go with what works day in and day out. And commodities are needed day in, day out. So the royalty model, where companies make upfront payments to fund activities for these miners, and once the mine is operational, they just get a steady stream of a portion of the ore body for an agreed upon discounted price, and they just turn around and sell it to the marketplace at a very fat margin. If you take Franco, Nevada, and I wrote about all of the royalty industry and how you can make money, immediately on it, in my opinion, at wealthresearchgroup.com/royalty. And I talk about the big royalty companies as well there. I think they're very expensive right now, and I wouldn't be putting money in them myself. But the idea is they make upfront payments, and then instead of getting an interest payment back, they get a royalty stream for the duration of the life of the mine. So they can contract where, hey, I'll pay you $1 million now, and for the rest of the life of the mine, I want your silver or part of your silver at $5 an ounce. And then they can just flip and sell it to the market at 17 or at spot or whatever. It's an amazing business model, and it's outperformed both the spot price, the miners, all of the ETFs, all the managed money. Just a great model. But because it's so expensive and everybody knows it's working, it's hard to find it on a discount. And so what I looked for recently, Kenny, is a company that is doing the royalty model in an undervalued sector and in an under the radar way. So I looked for a new company that people haven't researched yet. So that's something that I've been focused on for at least 90 days now with Wealth Research Group.
You've been obviously ahead of the trends, and you've covered things before they were hot topics, because that's the idea with making money in just anything. And one of the sectors you've covered here is cannabis. And this is going to be a very big thing here in 2018, especially with California just legalizing recreational cannabis, the 6th largest economy in the world. And I got to ask you, what does this mean to you? What are your thoughts on this currently?
First of all, cannabis is already biting into alcohol. So you already seen Constellation brand, a company that is the owner of Corona, is the largest premium wine company in the United States, and one of the best performing stocks since 2008 in the world. It's up about 600% since the recession. So it's a brilliant company, and it's covered by some of the biggest analysts on the planet, and is owned by some of the best hedge fund managers. And they actually took a big chunk of equity and bought a part of one of the largest cannabis companies. So we're already starting to see some merger and acquisition activity, but all of these companies have a huge problem. The problem is Jeff Sessions. And so they can't enter the cannabis sector because it's federally illegal. So what I was looking at is, hey, there's got to be a way, there's got to be a loophole where some companies and some entrepreneurs are figured out how to how to take advantage of what's going on in the U.S. in terms of the federal side. So the fact that California legalized was a huge deal, and I went to California. I looked at what's going on. One of the best ways to make money in California is to raise money to buy warehouses in real estate, get into the real estate side of cannabis. But it's very hard. The barrier of entry is incredible. There's so many real estate sharks that are already swimming in the waters there, and it's hard to get a good deal. So what I was looking at is maybe there's a royalty company that is active in the marketplace there, because A royalty company is essentially like a bank. It funds these companies in exchange for a future return. They don't want interest payments, they want part of the profits, but it's essentially a bank. And since we know that the big banks, and you've seen this because you went to California yourself to check this out, the big banks and even the community and regional banks, they don't even want to open accounts for these cannabis companies, let alone originate a corporate loan for them. So a royalty company would have an unfair competitive advantage. They're essentially the only funding institution working in the marketplace. So all the great startup companies with the best potential, they go to them, and they can turn 90% of them away and just stick with the best. They don't need everyone's business. They only can sift through and find the best ones. And I was lucky enough to find a private company called Fincana Capital Corp that just went public in the US a few days ago, and it's completely under the radar for now. But I personally mailed my research to a number of hedge fund managers in New York who are already taking a look at this. It's a huge opportunity. If you take a look at our research at wealthresearchgroup.com/cannabis, I'm sure that you'll see that the amazing part about it is that these revenue streams, these royalty streams, haven't kicked in yet. And so I believe that once they will, and I spoke to the CEO, he can't guarantee anything, but it looks to be over the summer that these revenues will start to kick in. And I love to see the company started reporting earnings, and for such a small company to start reporting these steady earnings, it's going to be very easy for investors to figure out the intrinsic value of this company. They have zero debt, and I am personally involved in a major way as a shareholder. And this is an opportunity that has to do with Uncle Sam doing us a favor on the federal level. So we don't know how long this will last and how long this company can operate in an environment where they have no competition from the banks. So that's why I love it. It's a time-sensitive opportunity for me.
Yeah, absolutely. Crush followers are familiar with this one. We sent an alert out just this week, and looking at the chart here, it's at a massive discount to where it was trading at not too long ago. So it's very exciting, the opportunities we have here to be in the early stages of these brand new trends. And let's move on here, Lior. One of the things I refuse to do is be behind in trends. And Tesla is a company that is worth more money than Ford right now, selling only 100,000 cars in 2017 and actually incurring a loss. While Ford sold 6.6 million cars in 2017, earned billions of dollars, but is actually worth less than Tesla. I got to ask you, what does this mean to you as we are trying to anticipate what the trends are going to be going forward?
I think it's a great question, Kenny. Investors and just any people, any person in life, he has to make sure that he's not a first-level thinker. And first-level thinking is something to the effect of Elon Musk is a great business person. I'll just buy anything that he does. That's a first-level thinker. And so Tesla is overvalued, but overpriced. And second-level thinkers say, okay, the market thinks that since he founded PayPal, he's a genius and he can do anything he wants in any sector. But we know that human beings are, that there's a learning curve. So, hey, maybe Tesla is not such a great company. Let's either avoid it or short it. And a third-level thinker thinks, okay, well, Elon Musk is a great entrepreneur, but he's not perfect. So Tesla doesn't deserve this type of valuation. Maybe I'll buy an undervalued manufacturer like Ford, which is deep thinkers. But a fourth-level thinker is going further. So as long as you keep thinking and raising questions, you'll get to the bottom of this. And you and I talked about this off the air, and you told me a great idea here, which I share with you completely. And the fact is that perhaps the best way is to look at what underlying commodities are important for EVs and not bet on any company. because Volvo is involved, Volkswagen is involved, BMW is involved, all these companies are involved in the electric vehicles, Toyota is involved. Who knows which company will win the race? But why bet on one of them when you can bet on the trend itself? And I think it's a great idea what you told me about this. Bet on the trend itself. So let me tell you how I think about this. Andrew Carnegie, who was the richest mining industrialist ever, he had an opposite idea, contrarian idea to all the other people. He said, you know what, the steel price is $140 at the time that he was alive. I want to move it down to $7. You know, there's few entrepreneurs out there that think that lowering the price of a commodity is good for the bottom line of a steel manufacturer. But he thought so because he said, look, at $140, I can't sell steel to many industries. There's only a few amount of industries that can afford to buy steel at $140. But at $7, I can sell so much more steel. And what he was able to do is lower the price that much that steel beams got involved in real estate, in skyscrapers. Before that, people didn't use steel for real estate, for construction. So he started that revolution. And what people have done in the electric vehicle sector is they said, let's lower the price of the battery and make the EVs more affordable. How do you lower the price of the battery is a technology issue. But what's important to understand is if you lower the price of the battery, more people can afford EVs. That means it needs more raw materials like lithium and cobalt. And so what I think going forward will happen is the availability of cheap electric vehicles by all of these manufacturers will become a part of the norm. And what they'll need to figure out is how to source cobalt and lithium, because right now there is no replacement to them. You can already see Apple going into the mining business actually, and trying to contract with miners directly without any middleman. Especially in the cobalt sector, because a lot of it is linked to child labor and to the Republic of Congo, 2/3 of it, and they want to see what to do. So many great opportunities in terms of cobalt and lithium going forward.
Absolutely. I couldn't agree with you more there, Lior. I think electric vehicles are the future, despite politics. I know a lot of people have this political tie to them. And no matter what, we want to be agnostic to the trend. We want to make sure that we're on the right side of the trend. And I think electric vehicles and the trend is going to be with the underlying commodities. Very intelligent things you're saying right there. Talking about trends and just getting an update on what you think is going forward here in the crypto space. A lot of people are worried about where we're at. Are we in the bear market? Is this the end of the 2017 hype, and what to expect going forward here? So what are your thoughts here when it comes to cryptocurrencies, Lior?
So I think what's going on is the top projects, or the top 100 crypto projects, they are in the steady development mode, right? These are not cryptocurrencies. The name is so misleading. These are crypto-based projects. Each of them solves a problem in the real world. Most of them solve problems of wiring money or wiring value very cheaply, very instantly, etc. Some of them solve other problems. But the market is looking for something else. The market is looking for the next stage for these cryptocurrencies. And what the market is looking for is what I call the Seamlessness Revolution. And the Seamlessness Revolution is basically akin to what happened in the 90s on the internet, where all of these computers had softwares that were good for them, but the computers didn't talk with each other. They couldn't communicate. And then came the router, right? Then came routers and interconnected all of these computers around the world and created a network effect, which is the base of everything that has to do with cryptocurrencies. So the next stage for cryptocurrencies is which crypto projects are working on a language that will connect cryptocurrencies. If I have data on the Bitcoin network and another person has data on the Ethereum network, they can't interconnect right now. If you can make that happen, and I know a few cryptocurrencies that are working on it, and we'll update those in the next, in the coming weeks on Wealth Research Group on the newsletter. This is the breakthrough. This is something that the crypto economy is waiting for, and I don't think it's in a bear market at all. I think people are just, saying, hey, there's no reason for me to commit new funds. I've made a lot of money. Let me take some profits. So that's what I think happened in January, coupled with a lot of fear-mongering and regulations and the fact that tax seasons has come. But overall, the definite trend is higher, but not overall for 1,500 projects, but for the few projects that are actually worth something. So the way that I like to position myself in 2017, I love to position myself with the privacy coins and the leading coins. So for example, Wealth Research Group covered Bitcoin at $400, Ethereum at $12, Dash at $30, Litecoin at $20, Monero at $19. These are all exceptional returns. But in 2018, I think what's very important is to understand the game has changed. You need to look for to the crypto projects that are able to help the mass adoption economy. Which ones help the banks? Which ones help the traditional economy? Which ones will attract more people, new people into this industry? And these will be the ones that flourish the most. And we'll update that a lot in Wealth Research Group. And what I think most importantly, you don't stop comparing to precious metals. Just stop. There's nothing that they have nothing to do with each other. The fact that Bitcoin went up so much made people believe that it's a store of value. It's not a store of value. It's a great medium of exchange. It's a great technology. It's a great way to put money off of the system. It's not a store of value. What it can do, though, is it can make transactions in the gold sector very easily. If you put your gold ounces on the blockchain and then you want to move money around and move it through, move it digitally, not move the actual gold ounces from one place to another, but sell just the physical, the digital ownership of it using the blockchain. I think that's where actually cryptocurrencies can help gold and silver, and I think they can complement it. So just make sure you understand cryptocurrencies are technologies and they're not currencies. And if you can understand which technologies will help the world, it's no different than any other tech revolution that has happened thus far. And if you bet on it at the right moment, like Cisco, for example, which has created more millionaires than any other company on the planet. It's estimated that 10,000 millionaires came out of Cisco thus far. So I think that kind of wealth could be unleashed with the right projects going forward, Kenny. No bear market in my mind.
Solid. Lior, and this goes with blockchain, but many people are worried about scams or worried about people worried about losing money in the cryptocurrency space. But honestly, I think blockchain is there to solve the honesty problem, make things more transparent, and really bring real world solutions to society that society needs. And that's where I agree with you. There's so many solutions that will be had on the cryptocurrency blockchain platforms, and it's really exciting. But in closing here, Lior, with everything that's going on with blockchain, AI, technology, self-driving cars, and everything just changing so fast, faster and faster by the minute, what do you suggest people do to fortify their financial moat? And just some closing thoughts as we close out this interview.
Well, I think for many people, they need to recalibrate how they live. It seems to me like there's so many opportunities for what I call location-free businesses. You don't need to live in New York City in order for your clients to be in New York City. So you can tap the richest clients in the world, but yourself, you can live in a much cheaper environment. You don't need to be in the locality of your business at all times. And that is something that's very important. The best way to lower your costs is to move to a low-cost environment. If you can do that without losing your business environment, that's great. For people on salaries, I think that they cannot move, obviously. So what they need to develop is secondary income streams. And I think one of the best ways to do that is to go with low level of entry businesses. So businesses that you can start up for a few $1,000s max that don't have an incredible learning curve. You don't need to go to university for 4 years to get involved. And that they're part-time, so you can do them, like a throttle. If you want to go full power, go full power. If you want to take it back, take it back. If you're swamped at your main job, then leave them alone. And they have really low overheads. You need to figure out which kinds of secondary income streams you can involve in your life, and do them, and use a team to do them. So there are many ways to do that, and part of the ways one way that I do that is in the real estate sector. And the way that I do that is I have a lot of my assistants in the team based out of India. The pay that you need to pay these people, and they speak great English, have great skills online, etc. You need to pay them like $7 or $8 an hour, and you get very hard workers because for them it's survival. So they're committed to your work, and you can live anywhere and do business in the best locations. I've done that in the real estate business. I can't go into all the details because it's a 20-minute conversation in and of itself, but you can go to wealthresearchgroup.com/niche, like NICHE, and you can check out one way that I've developed or that I've mimicked people that have been successful in the real estate market, that is actually very good for today's environment. And you can even make 5 figures a month doing this part-time if you know what you're doing. So there's so much opportunity. You got to really focus on one thing, build it right. And personally, I don't believe in full retirement. I feel like I always need to create and be productive. So for me, it's always about what can I do to create a win-win. And I think people that are listening to this, that are approaching the retirement age, rethink if you want to have a full retirement, because statistics shows that when people stop being productive at all, something happens to them, to their psyche. They start to feel like they're not important anymore. And all of the insurance companies that work on this, people have shorter lives because they retire. So stay active. You obviously have a lot of skills. You can contribute so much to the world. Why not stay active? Get a consultancy job where you can consult to other people and take your time with it. Do things that are part-time and are easy to do in your community. Keep being productive, and don't go into what I call the full retirement flow, where you become fully dependent on your assets. You're going to find that very unpleasing, in my opinion. And it's my opinion to you guys, to listeners that are approaching the retirement age.
Sure. That's great advice, Lior. And anyone who wants to check out Lior's work, please visit wealthresearchgroup.com. We'll have the links in the description area. Lior, thanks for coming on Crush the Street.
Hey, thanks, Kenny, for having me.